We're looking at Chapter 17 related questions, and the next one we actually came to is not 11, but it's actually up here in number 10. And number 10 talks about a casualty loss. We're going to actually let you work that one and try it, because number 11 that we are going to look at together does the same thing. It just has a little element to make sure we discuss at it. So Mr. and Mrs. Blake suffered 2 casualty losses this year. Mr. Blake's wallet containing $1,300 cash was stolen, and their uninsured sailboat, which had a basis of $67,000 and a fair market value of $50,000, was destroyed by a tsunami, which is a federally declared disaster. Compute the Blake's itemized deduction for casualty losses if their AGI was $112,200. Okay, so we're going to work through the process. One thing that we want to make note of is a change. So before 2018, this first event when Mr. Blake's wallet containing $1,300 cash was stolen, you could actually make a case and put that and try to, add that to your casualty losses. Since 2018 started, that does not count because it is not a federally declared disaster. So we're not even going to look at that. So we're going to be concerned about this sailboat because it was destroyed in a federally declared disaster. So one thing is, what amount are we talking about? And this actually adds another element in, I guess. You're going to take the lower of your fair market value or your basis. So the basis was $67,000. Current fair market value was $50,000. Well, you say, why is that? I think they just don't want you to get too creative every so often and saying, okay, we paid $67,000 for this boat 3 years ago. Right, we're going to do something and get this loss, and then we're going to go back and buy it back at $50,000. So somehow we're going to make $17,000, kind of in general. In my opinion, that's why they put that there. I guess the other or more official reason they would say is if you had to go out and buy the same boat, right, not a new boat, but the same boat, you should be paying fair market value of $50,000. Is that saying that you're going to get it for $50,000? Right? No, but it's saying that that's the thought. So that's why the first thing is make sure you take the lower of the fair market value or your basis. But most of the time it's going to be fair market value unless you're talking about maybe a collectible or maybe real property. Right? Most of the time your other property is going to wear out and go down in value. All right, so first thing we have is that $50,000. So we're looking at that. If you look in a chapter and no, I have no understanding, I can't tell you exactly why they did this, but there's this thing called a floor. So they have a $100 floor. Basically, for each incident, you need to reduce the amount before the floor by this $100 amount. In other words, they think you could easily eat the first $100 and then not have to file it. So they're going to make you reduce it by $100. Right? I don't understand why they're making us do all of that because, that's not $100 of tax you're reducing it by. That's the deduction amount, and your tax is a percent of that. But anyway, and it's per event. So this one is going to be $49,900. So let's just think back. Before, just so we can cover it, if this was before, or maybe you have 2 federal disaster areas or claims in 1 year. So before the change was made, if you were taking the $1,300 as a claim, you would have to take the $1,300 and also reduce it by $100. So that floor is per event, not per year, per event. But in this case, we only had one that qualified anyway. So we get $49,900 here. So that's the first step. Then we need to look at the limit of AGI. So it's anything over 10% of AGI. So in other words, our AGI here is 112,200. We need to take that and multiply it by 10% to find out what it thinks we need to at least meet, right? So this amount $11,220. In my opinion, they're also saying, based on our AGI, we should be able to easily kind of eat up or offset $11,220 on our own without getting any kind of help on our tax return. It's just that part that's over the 11,220 that's going to be able to help us on our return. All right, so 49,900 we said was before. Now we figured out the limit, AGI limit was 11,220. So anything over that limit is going to be the amount that we can take on or add to our itemized deduction, right? It doesn't mean it's going to be offset in tax. So let's do that backwards here. Whoops. 49900 minus. So we have $38,680. That's the amount that's going to go toward our itemized deductions total overall. Right, if that's our amount that's going, it's probably going to help us get over that standard deduction amount. But that's just a little bit. So number 10 here works the same. So I'm going to let you hit pause here for a minute, and then I'm going to come back and tell you what I came up with. All right, so you should come up with $12,080. Okay, so let's look at here, gambling winnings and losses. So over the course of the year, Mr. Sue won $8,200 and lost $5,900 gambling in the local casino. Mr. Sue does not itemize deductions on his federal tax return. What is the net effect of his gambling on Mr. Sue's taxable income? So there's a couple of keys here. So let's start before we even look at in general. So general, your gambling wins, they go on your front page of your 1040. Right, so in your income section, if you have losses, they go on Schedule A. Right, so they add toward your itemized deduction total. So in this case, not to go ahead and give it away, but he's not itemizing, which means what? He's not really using Schedule A. The other thing, though, even if you're putting on Schedule A, the amount you put on your Schedule A is limited to the amount of your winnings. So I don't think it's going to hit us here. But a lot of times you'll have a client who's real happy because maybe they won $25,000 gambling, but then they also bring in the receipts for where they lost, and their losses are more than their winnings, right? So when you put the amount you put on their itemized deduction on Schedule A, you first need to limit it to the winnings, limited to the amount of winnings. Okay, so you can kind of see here, $8,200 goes on the front page for Mr. Sue, so that is going to increase the income. Since he's not using Schedule A at all, this is really not helping him. So in this case, there's going to be an $8,200 increase in taxable income. If he was itemizing and that increases itemized deduction total, right, then you could do the offset. But since the key here, they're not doing itemized deductions, then it's not really helping them. The losses are not helping them. Okay, number 13 says, this year Mr. and Mrs. Franklin paid $93,000 interest on a mortgage they incurred to build their home in Santa Fe. The average principal balance of the mortgage was $1.43 million. The home has an appraised fair market value of only $900,000. Compute the Franklin's itemized deduction for their home mortgage interest. Right, so this gets us to looking at, I guess, a couple of things on home mortgage interest. Most of the time, unless you own this expensive house, which they obviously do, right, 1.43 million and 900,000. If you don't hit those limits, you can use your mortgage interest, and I think the rule is you get your mortgage interest on your principal residence and one more. Right, so on principal residence and one more. So maybe one vacation home. Now, if you have properties that you have on rental schedule, Schedule E, that's a whole different story, right? You're putting them on a different schedule. But as far as what you can claim on Schedule A, it's going to be your primary residence and one more. So that's one thing to keep in mind. The other thing, and that's what this hits us at, is up to after you, and I guess they're saying if you can afford the house this big, you don't really need 100% of your mortgage interest to be deductible. So, and that's what they've done in this case. So let's go over here, take a minute, because this is another thing that changed. That's where we are. Go back to our book. Here we go. So we're talking about qualified residence interest, and I think up here even, well, I guess it kind of tells us here. So if the mortgage, because I want to point out both, because you still work with mortgages that were acquired before December 15, 2017. Well, that's not unusual at all. So if the mortgage qualifies as acquisition debt incurred before December 15, 2017, your limit that you're going to be able to take total is $1 million. Right, so that's working through that example, but it tells us the same thing up here. Here it is. Acquisition debt. So after December 15, 2017, so anything that where the purchase of the house and the, well, I guess the actual giving of the mortgage was after December 15, 2017, the limit actually dropped to $750,000. And if you are married filing separately, it's $375,000. Notice that doesn't say for single, just for married filing separately. And again, it just says before the debt for that date, it's going to be $1 million. Right, so unless I tell you otherwise, we're going to assume we've moved on to the new limit of $750,000. But don't always assume that's going to be the case when you're in practice, because that's only 5 years ago, and most mortgages are 30 years. So you're going to have that kind of decision. Here's the example that the book walked through. We can just look at it. So right, they had paid $44,050 of interest, but the principal balance was $890,000. So what they were saying, and this is one of those cases, just to let us know that it did impact some people. Right, if the mortgage was before December 15, 2017, they didn't go over that $1 million limit, so all of their interest would be deductible. However, if they got the mortgage after that date, you would go over that $750,000 limit. So how does the formula work? $750,000, that's the limit's numerator. This is the total debt. The $890,000 is your denominator. And you multiply that by the interest that you would have been claiming, right? $33,600 interest is set for that year. So that means your total interest that you are allowed to deduct would be $28,315. Right, so let's go back and work our problem, because again, we're going to use the $750,000, but you're over that limit. So we had $750,000, that's one of the numbers. The bottom number is going to be your loan amount. Has nothing to do with the fair market value. $1,430,000. You take that and multiply it by the $93,000 of interest, and that answer is going to give you what's going to be allowed. So let's take the 750 divide by 1,430,000, and multiply that by 93,000. So what's going to be deductible is $48,776. So notice that's actually none of the above. So that's current. If you had done using the 1 million, I want to say it actually worked out to A, but that is if you assumed it was before. But we're going to use the current $750,000. So the limit would be, or the amount you can add to the rest of your Schedule A numbers would be $48,776.